Hey everyone, welcome back to Corporate Decoder, the place where we dissect the most complex financial documents and find the hidden stories within them. And today we're tackling a company that has been through quite a bit of change lately, Cyclacel Pharmaceuticals. Incorporated, its latest filing gives us a peek at its financial health and the tough road ahead for this. Clinical stage biopharmaceutical company, its future truly hangs in the balance, and we're going to break down what that means for investors and the company itself. Before we dive in, if you love getting these clear, concise breakdowns of company filings, make sure you are subscribed, and hey, we have a fantastic Discord community linked in the description below where you can connect with other finance enthusiasts and get more insights. This amendment to their annual report for the 31st of December 2024 is here to clean up some audit housekeeping and reflect some serious shifts at the company. First off, the company is now known as BioGreen Med Solution, incorporated after a name change in September 2025, but they're still reporting under their old name Cyclaceuticals Incorporated for this. Filing the big story here is a refocus on their Plogo clinical program and a move away from other drug development programs. This signals a clear strategy shift, driven no doubt by financial pressures. Let's not sugarcoat it, this company is in a tough spot. They have a history of operating losses and expect to keep losing money for the foreseeable future. They've even stated directly that their stock is a highly speculative investment, which is corporate speak for proceed with extreme caution. As of the 31st of December 2024, they had an accumulated DeFi SID of over $439 million. That is a lot of red ink. We need to see how they are managing their money and where they expect to find more. Looking at their financials as of the 31st of December 2024, their cash and cash equivalents stood at about $3.1 million. Now that might sound like a lot, but for a clinical stage biopharmaceutical company constantly pouring money into research and development, it is not a huge cushion. They also reported a working capital deficit of nearly $2.6 million. This means their short-term liabilities are higher than their short-term assets, which always raises a flag about their short-term financial health. As expected, their operations are still burning through cash in the year, ending the 31st of December 2024. Net cash used in operating activities was almost $8 million. This is a significant outflow. This means their core business activities are not generating enough cash to cover their expenses, and they are relying on external funding. This is where we see how they have been staying afloat in 2024. They brought in over $7.8 million through financing activities, mainly from issuing stock and warrants. And from warrant exercises, this is how they are funding their operations and development. So the capital markets are crucial to their survival. However, they also saw a significant decrease in their research and development expenses by about $12.5 million compared to the previous year. This is largely because they've paused or finished certain trials and are focusing on the Plogo program. This cost-cutting measure, along with scaling back other programs, is a direct response to their funding situation. Their general and administrative costs also saw a decrease of around $1.3 million, which is helping them manage overhead. But it is important to remember that while these cuts are necessary, they also highlight the company's financial constraints. Revenue is not a strong point here for the year ending the 31st of December 2024. They reported only $43,000 in revenue. This is a massive drop from the $420,000 reported in 2023. This revenue comes from recovering clinical manufacturing costs for a study managed by Cedars Sinai Medical Center. They frankly admit they do not expect to report revenue for the foreseeable future, which is a stark reality check. The auditors Fire Malaysia Plc have issued their report, and they've highlighted something critical right up front: substantial doubt about the company's ability to continue as a going concern. They point out that the company does not currently have sufficient funds to complete development and commercialization, and has a limited cash balance. This is a serious concern, and it means there is a real possibility the company might not be able to continue its operations. One of the auditor's key points, the critical audit matter, is about how they track their clinical trial expenses. This is understandable because these costs are huge and involve a lot of estimation. The auditors spent significant effort verifying these accruals because they are material to the financial statements and involve subjective judgments, particularly when dealing with third-party contractors and international sites. Digging into the notes, we see the stark truth about their financial situation. Management itself states that based on their current operating plan, they anticipate their cash will only last into the second quarter of 2025. They continue to seek more capital, but there's no guarantee they will find it. This going concern warning is not just corporate jargon, it's a real sign that the company is facing an existential threat. Their recent financial activities show they've been active in raising cash. In November 2024, they entered into a warrant exercise and reload agreement, and in April 2024, a securities purchase agreement bringing in millions through stock and warrant sales. They also had a registered direct offering in December 23. This pattern of Continuous fundraising through selling equity is common for companies in their situation, but it also means existing shareholders are facing significant dilution. Their financing activities are crucial for survival, but come at a cost to current investors. Let's talk about their stock. It trades on the Nasdaq Capital Market under the ticker Cyc. They've had a 15-for-1 reverse stock split in December 2023 to try and boost their share price and meet listing requirements. They recently regained compliance with Nasdaq's equity requirements, but are now under a mandatory panel. Monitor for a year, this shows the precarious position their stock has been in and the constant effort to avoid delisting. Now about those risks their filing lists, a ton of them, we'll zoom in on the most impactful ones. First off, clinical trials are incredibly expensive, time-consuming, and can be delayed for years. They might need more money than they have to finish development and bring any product to market. This is a huge hurdle. They also admit their reliance on biomarkers that are not scientifically validated, which could mean wasted resources if those markers don't pan out. Competition is another major concern. They are in a crowded field with big players that have much deeper pockets. Many competitors may develop drugs that are cheaper, safer, or more effective than Cyclacel's candidates. This means even if their drug works, it might not win in the market if competitors offer a better package. Their business strategy is to focus only on the Plogo clinical program. They've decided to market their other drug development program for Accession for sale. This is a clear sign of streamlining operations to conserve cash and focus resources. It's a smart move given their financial situation, but it also means they are putting all their eggs in one basket with Plogo. Looking at recent developments, the company announced in December 2024 that they were exploring strategic alternatives, including a potential deal with investor David Lazar. This led to a securities purchase agreement in January 2025 with Lazar for $3.1 million. This money is slated to settle liabilities and cover general costs. For its purposes, they are also liquidating their United Kingdom subsidiary Cyclacel Limited and deconsolidating its financial results. This whole process of selling assets and restructuring shows a company fighting to survive and manage its remaining resources. They also mention cybersecurity risks like unauthorized access and data loss. While they say they haven't experienced major incidents, it is a constant threat, particularly for companies handling sensitive medical data. The management discussion highlights the ongoing struggle. Their principal executive office is now in Kuala Lumpur, Malaysia, showing a global shift, and they've recently terminated their lease in New Jersey. Moving their headquarters, this is a cost-saving measure and part of their broader restructuring efforts. Let's look at the actual balance sheet numbers as of the 31st of December 2024. Total assets were around $4.1 million, a drop from over $8.8 million the year before liabilities. Also decreased, but they still have over $6.2 million in current liabilities. The big picture here is that their accumulated deficit is huge, over $439 million, and their total stockholders' equity is a deficit of over $2.1 million. This confirms the auditor's going concern, warning their financial position is precarious. The statement of operations shows the net loss for 2024 was about $11.2 million, an improvement from the $22.5 million loss in 2023. This improvement in loss is mainly due to the reduced R&D spending, but it doesn't change the fundamental issue of not generating revenue. The income tax benefit shown is from UK research and development tax credits, which helped cushion the beat. Low, but these are finite resources. The statement of stockholders' equity really lays bare the dilution from all these fundraising rounds. Their common stock has dramatically increased in number of shares outstanding due to these issuances. While the value of existing ownership continues to be diluted, the preferred stock situation is also complex, with various series having different conversion and liquidation rights. This creates layers of complexity for common stockholders, and the net loss per S-share for common shareholders is astronomical $504.30 loss per S-share in 2024 and over $6,000 loss per share in 2023. This number is skewed due to the small number of outstanding shares after the reverse split, but it still points to severe underperformance. Now for my take on Cyclaceuticals Incorporated, or BioGreen Med Solution. Incorporated, as they are now known, this company is in survival mode. Their strategy to focus on P-Log O is a necessary move to conserve cash and dedicate resources to their most promising asset. The fundraising activities are keeping them afloat, but at the cost of significant dilution for existing shareholders. The going concern warning from their auditors is the most important takeaway. Here it means their ability to continue operating is in serious question. Opportunities Exist if Plogo shows remarkable clinical success and they can secure further funding, but the risks are enormous regulatory hurdles, competition, and the ever-present need for capital are massive challenges. So, what's the bottom line? Cyclacel Pharmaceuticals is a speculative investment. Indeed, their future hinges on the success of Plogo and their ability to raise substantial capital from investors or partners without a significant breakthrough or a strategic acquisition or partnership that injects a lot of cash. Their path forward is extremely uncertain. It is a high risk, high reward situation, but right now the risks seem to heavily outweigh the potential rewards. What do you think about Cyclacel's situation? Are they making the right moves to survive, or is it too late? Let me know your thoughts in the comments below. If this deep dive was helpful, give this video a thumbs up and subscribe for more corporate analysis. And hey, if you want to join the conversation and connect with other finance enthusiasts, check out our Discord community linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.